Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and joined by my co-host,
Andrew. Bill's back again for another episode.
Andrew, we are back again for another episode, and it does feel good because we are on video, so broadcasting on YouTube.
Successful as well. We didn't bung it up too much the last time round, so good to be on video and good to be back recording another podcast.
That's it, getting some good feedback, but I think the one thing that we need to do is maybe just increase the quality of the camera, so that will be coming as well too, just to try and make...
Is it the camera or the people behind the camera?
Make this look a little bit better. We'll wait and see. So time will tell. So Andrew, let's get straight into it. What are we talking to everybody about today?
Yeah, so today we've got a bit of an interesting topic, and we're doing it a little bit differently as well than what we normally do. So today what we're doing is the broad context of what we're talking about is active versus passive investments. However, we're picking sides. So Billy and I are going to pick sides. One of us, so Billy's going to play on the side of the passive investor. I'm going to play on the side of the active investor. And we're going to have a little bit of a debate around, what should you be doing? Should you be going down passive investments or active investments? So it's going to get a bit physical. It's going to get a little heated in here, but...
We should put a caveat over the top of this in terms of the advice that we give to clients. Right, we don't necessarily sway one way or another. We have different strategies for different clients, for different appetites. So it's a really difficult proposition to argue against when that's not your traditional position.
Well, it's going to be for this podcast. So you're going to have to get passionate. You're going to have to, dig your heels in and go for broke on your side of the fence.
We have an ongoing sort of currency in the office that whenever we do something, we always, and we shouldn't be gambling, and we don't endorse that, right? But every time we do something, we're like, I bet you a cup of coffee. Whatever the outcome is. So
we're clearly coffee addicts.
So over to you guys. Whoever debates this better. You guys can let us know. Put comments in the on the podcast, and whoever loses buys the other person the coffee.
Done.
All right, here we go. Andrew, kick us off.
Well, I think the big point to kind of get onto before we actually even get into it is what's the difference between passive investment and active investment. What are the different options that are available for investors out there? So taking it a step back before we start swinging. The difference between them and the major thing between them is an index fund or an index investment, passive investment, whatever you want to call it. So a couple of interchangeable terms there. Will track and follow a market. So we'll purchase into the largest assets within a certain market, and it will just follow whatever the largest assets are doing. An index or an index investment is usually, and we'll get into it, but from an ease perspective, it's a bit easier. From a cost perspective, it's a lot cheaper because a fund manager is not, picking and choosing individual options.
Sounds like you're arguing the wrong point here. 1 point to me.
Yes, clearly. I just, want to give them a little bit of,
false sense of security.
Yeah, exactly. Whereas an active investment is an investment where you're actively trying to overperform the market. Now, this can be done in the form of a fund manager, where a fund manager is, picking and choosing specific stocks, for instance, that they believe is, the most appropriate. It can be done from, a property investment. If you're purchasing a residential property and you're wanting to purchase an investment property, you're not following an index, you're trying to overperform. And so what you're doing is, it's picking a specific investment that's trying to overperform its respective market.
Yep.
So a couple of different ways that you can invest, but we're gonna jump into arguing our side of the fence. So kick us off, Bill. What's
just on that note, just before we do, so with the index in particular, I guess we should break it down just slightly. That you're talking about a respective asset class. So I'll pick as an example Australian equities. You can pick a passive style of investing that tracks the Australian share market. As an example, as a passive or an index fund, whereas from an act, and essentially what you'll get is the rate of return of that respective index. So looking at something like the All Ordinaries, an index fund will track the performance of the All Ords, which is basically the biggest companies in Australia that are listed on the stock market. Whereas an active manager takes the position that they are trying to outperform that respective benchmark.
Yeah, exactly right.
Got it. So off with the gloves, and here we go. One of the biggest things that I think is really relevant with indexed versus active comes down to cost. So if you're following an index, the infrastructure that you need, the skill set that you need, and obviously not discounting from our indexed investment partners, but there's a lot less that you need to be doing because all you're doing is tracking the respective market or the respective index that you're following. So by that very nature, the cost and the management expense ratio, that's how we determine the cost of a fund, that's how fund managers charge, is a lot lower in an indexed option than it is in an active option. And the benefit of that is that you don't have to make as much money from a performance perspective to offset and cover the cost associated with it. So cost, smack bang, nice and easy, right there on the table. 1 point to me. Thank you. Mic drop. Done.
Yeah. Look, I'll give you that one. Cost is definitely in most instances. I don't want to say all because I'm sure someone's going to find, the one active manager that doesn't charge very much. But cost in most instances is one of the big things that an index fund has. However, I'm also going to note a 15-year-old Toyota is also going to cost less than a brand new Ferrari. Yeah, sure. From a cost perspective, one wins when you're only looking at it through that lens. But I'd definitely much rather be driving the brand new Ferrari. So, yes, cost is a relevant factor when you're making investment decisions, but it's what are you getting out of it as well. So, an active manager, while they may be charging a more expensive, MER or management fee, if they're overperforming the index more than what the cost difference is, then you're far better off paying that little bit extra, paying the additional, fees and costs associated with an active manager, but getting that benefit in overperformance and the alpha that or what you'd call it in finance terms, in terms of the difference between the additional benefit in performance, less the cost differential between an index manager and an active manager. So absolutely got it from a cost perspective, but the quality of an active manager will determine the rate of return, and ultimately you're better off paying more but getting more in the flip side as well.
Valid point. Going back to the Toyota and the Ferrari, depends on what you need the vehicle for. So if you're using it as transport,
back to financial planning.
If you're using it for transport from point A to point B, what you didn't fail to mention that in that analogy, you're actually talking about being on a dirt road and being on a farm. So the Toyota is actually better than the Ferrari, right? So,
well, it all comes back to exactly the same story when you're talking about investments. Make sure that it's all part of your investment journey. You're doing it for a greater purpose, and you've got a strategy in place. But yeah, I think we're too non-biased in this topic where we see each other's viewpoint and always meet in the middle. But that's all right. We're going to try and stick to our lane and going to try and argue our points nonetheless.
So cost is the first one,
yeah.
And I guess it's fair to say that I won that one, hands down. So that's fine. Diversification.
Yes.
Let's talk about diversification when we're talking active versus indexed funds.
Now I'm gonna pull an M&M, and what I'm gonna do is actually already preempt what Billy is gonna talk about, and refute that fact so he doesn't have anything to talk about. Look, diversification. All the passive investors are gonna talk about. You invest in the S&P ASX 200. You got access to all of the top 200 companies within Australia, and so an index fund from a diversification perspective, when you look at it from a surface level, is a more diversified option. Whereas an active manager, most active fund managers, especially when you're looking at things from a stock perspective, they're going to invest in, most of them will invest in 30 to 50 different stocks. So from a surface level, index looks like they're a more diversified approach. However, if you look at the Australian market, for instance, very, very heavily skewed towards mining and financial. So the index is really going to perform very heavily based on how the financial sector and the mining sector does, and doesn't take into account all of the other sectors in the market. So even though an index from a diversification perspective can look like they're a very diversified option, an active manager a lot of the times, because they've got the ability to essentially stock pick and look at specific investments, can have a truer form of diversification in an active manager if that is what you wish.
We'll just pause for dramatic effect there, right? Valid points. I mean, you take the Australian stock market into consideration, and you're right, the vast majority of the companies that make up and move the index are all of the big, let's call it the top 20 businesses in Australia, the banks, the miners, the grocery chains. We all know who they are. You're absolutely right from that perspective. If you're picking one particular index fund that represents, say, the Australian stock market. However, with products that are out there now, you can actually get specific with an index style of fund. You can invest in, robot technology, and just follows the index of those particular types of companies. So you're still achieving a level of diversification, but it's not in your traditional sense where I'm just following the Australian index. You can pick, the S&P 500, which is basically the American top 500 companies. Same sort of approach, it's a weighted index, but you can get indexed funds that exclude certain sectors if you wanted to play with your portfolio like that. So if you get creative, you can actually achieve a greater level of diversification with indexed funds rather than going the traditional way of just picking the Australian share market and away you go.
But you can do that with an active manager too.
Well, I'm only arguing my point. I'm not trying to give you points here, but you're absolutely right. But, there's obviously a lot more involved in it, which probably pivots into our next point around the difficulty of investing, or the challenge of investing, and the skill set and the knowledge required in order to pick active versus indexed.
Yeah. And I think that's kind of one of the keys in all of this as well, is an index fund, it's going to be easier. Set, forget. An active manager, while there's some benefit in investing in active managers, you can get that alpha in terms of performance. You can get, quite specific around exactly where you want your funds to be invested in. It does require, and it is going to require, an element of skill. So really, you're going to need to, in an active manager, you're going to need to select what is going to be, or which active manager is likely to overperform an index, which active manager is likely to do better than what the index is. And that's going to take an element of skill, that's going to take an element of knowledge, that's going to really require you to look at the intricate details of the active manager. Yeah. But the point that I'm going to put out there, and how I'm going to argue my side of the fence, is if you do put that time, effort, attention, and hopefully receive good quality advice for it, it very likely will or can result in a significant overperformance.
You did say that publicly. We are on camera, right?
100%. So, okay, 100%. Because
I'm taking some notes here.
I know exactly what you're about to say.
I'm going to keep it. You're not allowed to look at my notes, but I'm going to keep this until the end, because this is the barrier. This is the nail in the coffin that sorts all of it out.
Yeah,
okay?
Go for it.
But look, yes, investing in index funds are a lot more accessible. They're easier in terms of you don't necessarily need to think and dig deeper into what the underlying investment is, what's the objective of the fund, what's the manager attempting to do, what are they investing in, that level of detail and accessibility as well too, because some of those active investment styles you can't access unless you're invested in them in a certain way. You might need to go through a financial planner, you might need to be invested into an investment platform. Ultimately, I think that detracts people sometimes to be able to take away from that as well too. So once again, coming back to the indexing argument, it's more accessible, it's easier. I think it's easier for people to understand as well too, to a certain extent. So I think that's 3 points to me.
No, I just think you know, if, as long as you're not as simple as Billy and you've got, you know, an element of intelligence and, you know, you can actually, you know, be involved in your own finances,
Nice.
then absolutely you want to go with an active manager. You want to be the Rolls Royce, not the Toyota.
Yep. What about determining where you invest your money during different market cycles, right? Because the indexing argument, you just, you know, if the markets are going up and you're buying into that index, obviously you're doing a dollar cost averaging strategy, but because you're following the index, it's manager or style agnostic. You're not trying to pick not only the best underlying businesses like an active manager is trying to do, but you're also not taking or not considering the economic cycle. And my point here is if you don't have to do that because that's your style, then what do you do when markets change? Because investment markets, you know, don't stay the same. Businesses don't stay the same. Economic cycles don't stay the same. So does that mean that the active manager that you choose today in this economic cycle, if the cycle changes, their style is no longer relevant or less relevant and you need to change tact? I think that becomes a lot more difficult when we look at the index versus the active option, because just by its very nature, the same strategy that the active manager deployed over here may not necessarily be relevant in a different economic environment.
I think Billy's gotten a little bit confused. That's the whole point of an active manager.
We can rewind it. It's all good. It's all good.
No, but that's the whole benefit of an active manager. I mean, an index investment, you know, is going to just follow and track the market. So by that very argument, an active manager is not going to deploy the same strategy in the same market cycle. They're going to adjust their strategy depending on the market cycle. So an active manager should be able to navigate through that market circumstance whereby they say that, you know, this strategy that we were deploying around, you know, these specific investments were right in, you know, strategy A. However, an active manager should be looking at, okay, we've got a change in market that's happening. We need to adjust our strategy. We need to adjust our investment position. And as a result, we need to, you know, move into X, Y, Z in order to be able to still create a rate of return for our investors. The difference with an index is not going to adjust its strategy. An index is always going to be invested in that respective index. And the only way that that's actually going to change is if you change the index, which creates a bit of a... I would argue that if you're swapping indexes, so if you're moving from index A to index B, because of market circumstances, you're taking an active approach. Even though you're investing in an index, you're taking an active approach to investing rather than an index approach to investing. But that's just my argument.
Fair enough. Everybody's entitled to their opinion.
Point to Andrew.
Even if it is wrong. Look, no, honestly, I'd agree with you, but then we'd both be wrong.
Yeah. You know what? I'd rather that we're both wrong than you're right.
Valid point. Okay, let's talk performance.
Yeah, let's talk performance.
Let's talk performance. So track record across the active management sphere in terms of how consistently a respective manager is outperforming a respective index.
Yeah. Because
they all benchmark themselves against a particular index. What's the performance look like?
Yeah.
Or do we jump on to a different topic because we're doing ourselves out of
no.
Out of our profession here?
I know exactly. I mean, partly because I can read your notes, but I'm going to steal Billy's point for the note, and I'm going to take that away from him. Because what Billy's trying to get me to say...
This is going to be at the end. This is the nail in the coffin, what I've written here.
Oh, that's what you think?
Yeah.
What Billy's trying to say...
What I am saying.
Or trying to get me to say, which is 100% correct, is that most active managers will not perform their respective index on an ongoing basis. So the index will outperform the vast majority of active managers.
Over a
long enough period of time. That being said... there are active managers that do overperform their index on a consistent basis and have done so on a consistent basis. Now, I'm going to put it out there, past performance is not a reliable indicator of future performance and all of that stuff. Now, let's take Billy's personal hero into account.
You can't steal my thunder.
I was always going to. It was in here. Let's take Billy's personal hero into account here. Warren Buffett.
You're setting yourself up for failure.
You think I am?
Yep.
I'm going to ask a simple question. Would you invest in Berkshire Hathaway?
Now?
No, if you could go back in time.
Of course you would.
Of course you would.
Yep.
Is that an active manager?
Yes.
I think it's not a point. We just need to stop the podcast. So Berkshire Hathaway is Warren Buffett's fund manager, or funds management firm. Warren Buffett clearly states invest in an index. But Warren Buffett himself is an active manager that has consistently overperformed the index. So it goes to the point that, yes, there's going to be a significant amount of active managers that don't perform the index. However, there is also good quality fund managers that do on a consistent basis overperform the index. And so if you can find who those good quality fund managers are, and you can keep an eye in terms of what they're doing and what their plans are moving forward, you can overperform the index and create a greater performance despite all of the, costs that you're going to pay and all of that stuff. Billy himself would invest in an active manager that's not an index fund.
That'll be part of my closing remarks. And without doing ourselves doing an injustice to us and our business and our profession, I think it's fair to say that an active role does play part of a portfolio. So does an index role as well too. And finding the right blend and the right mix based on client circumstances, time frame, risk profile, the amount of money that they want to contribute into a portfolio. I think this debate can rage on for a long period of time. But from our perspective, in terms of what we do with our clients and in our business, and this is not me conceding, by the way, either, is we blend portfolios and we do a bit of both because there are certain elements of each different style that really appeals as well. As an example, if we've got a young investor who's never really invested before, we might go down the indexing path. And this is a bit of a generalization simply because they may not have as much money to contribute into the portfolio. So we're worried about or concerned about the cost associated with running and managing the portfolio. Whereas you might get somebody who's got more money to contribute. Maybe they've been on the investing journey before, so they understand you get a little bit more complex with active managers and what that looks like. So there may be that level of comfort and that appetite towards going towards a specialist manager who's investing in a particular asset class with the intent and the objective to try and outperform their respective index. Yeah.
And the other thing that you can do, which is a relatively common approach in the financial planning industry as well, is what's called a core satellite approach. So you've got, a portion of your portfolio that's invested in index managers that's just going to track and follow the market. And then you've also got another portion of your investments that's in active fund managers, which is used as the means to be able to create an overperformance in terms of the market. So you're taking an approach, sitting on both sides of the fence, yep, all within the same portfolio in order to be able to achieve a greater rate of return. But you need to take into account your personal circumstances. You need to take into account the amount that's invested because you don't want to be paying for active managers when you don't have sufficient enough balance, yep, to justify the potential overperformance. And you also need to take into account market circumstances, mm-hmm, because investing in, for instance, even in an index or an active manager, whatever it is, in a market that's not expecting to perform, it just you're not going to generate a rate of return either way. And so taking into account market circumstances, your personal circumstances, and where you're at in your investment journey is always going to be the right approach, and is always going to be the way that we're going to recommend clients, even though we're only arguing one side of the fence each on this podcast.
Which is interesting because it's quite difficult. But so closing remarks, I might go first just to give you time to get your thoughts and gather your thoughts because I think you're going to need it. But look, closing remarks from my perspective, and you sort of alluded to it before, but the great man Warren Buffett. right?
If anyone knows Warren Buffett, please introduce Billy.
You know, it's on my bucket list to go to Omaha and go to one of the annual general meetings and stuff, just so I can see him. But I probably should do it soon because he's getting on in age. But greatest investor of all time, greatest active investor of all time. He is once in a generation investor. He knows how difficult it is to do what he does. He actually tells people to invest in the S&P 500, which is an index, because he knows how difficult it is to stay consistent and beat the respective market. So if he's telling people that, I think that's good enough for everybody, and I think that ticks the box. Done, mic drop, coffee, thank you.
Warren Buffett.
Is that your closing remark? You're going to piggyback mine.
No, I'm back. My closing remark is going to be to refute yours. Warren Buffett, I'm going to do as he does, not as he says. Because on one hand, he goes out and says, invest in the S&P 500 because it's difficult to beat the index and knows how difficult it is. But on the other hand, he says, hey, invest in Berkshire Hathaway because we can beat the respective index and we know how to do it. And we've done it consistently and we believe that we will do it in the future. So I'm going to do as Warren Buffett does, not as he says, and I'm going to invest in an active manager that's going to outperform the index.
Weak argument at best. And on that note, look, I just think we leave it to our audience to decide. Let us know who you reckon deserves the points. And hopefully you got a bit of entertainment out of today's episode. And we introduced a couple of new concepts or thoughts around active versus index investing. And hopefully you side with me because that's the right way to go.
Thanks again for tuning into the podcast. And please do not, get into Billy's bullying tactics. You choose who you think was a better debater and made a better point and is obviously the winner in this podcast, which is clearly the person that's in a lighter coloured jumper than a darker one. But I'm going to leave it to our listeners. I'm not going to try and sway them in any way or use any of those tactics. But again, thank you for listening. Billy, thanks for an entertaining podcast.
Guys, we'll catch you on the next one.
See you later.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.